Good afternoon, everybody. Well, possibly not everybody just yet, but it's near enough 3:30, and we'll just have a check of the number of participants, see if we... there's probably got one or two more to come, so we will use up a minute or so just to revise the controls on your webinar, because we will be using some of these. There is a little hand symbol so that you can wave your hand. Not that anyone's found a use for this in the previous couple of webinars, but what we have done is we have chatted. So if we can just say, all click on the chat and say hello to everybody. Remember to select to everyone if you, or you can, of course, chat just with me. So yes, they're starting to come through. We've got an afternoon, everyone. Hello, hi. Good, hello all, hello. We found the chat box, wonderful. Hello, hi. So that is working. And we also have a Q&A box. Now the difference between the chat box and the Q&A box, I remind you, is that if you put a question in the chat box, then I will see it. But if there's a lot of activity in the chat box, then it will scroll up and be lost forever. If you ask a question in the quick Q&A box, it will stay there until I've dealt with it, either by giving you my verbal opinion or by writing back. And then we'll have a few polls, and we will just try this. Here is a practice poll. So you have a question there, and you select your answer and choose. So we'll see. Here's a highly probable poll that you've won a newspaper competition, and you have a choice of prizes. So you select your preferred prize. I think there must be a few Britons in the audience, because the wet weekend in Wigan is a famously awful activity in the UK. Very good. We've got 13, 14, 15 answers. There are a few more people. It's all right. This is not going to be recorded. I don't know who's voted for what. It's just so that we can establish that we know how to use the poll. That's good. 23. There's 20. Oh, 3 people can't make up their minds. I agree, it's a difficult choice. And oh, there are more people signing in, so that might be one of the reasons they've not all voted. We're just practicing a poll, and of those wonderful options, only one person would volunteer to test the medieval smallpox cure. 6 would take the 100 kilos of chicken manure. They probably have big gardens and they'll use it as manure. 5 would take the book, 10,000 verses of Vogon poetry. But the clear popular favourite is A Wet Weekend in Wigan, 13 out of 25. Okay, so you should now be able to see the results. So having done this extremely important bit of research, we will go on with the presentation. And today's wonderful, where is it? That's the screen I want to share. You should now be able to see the first screen, and we will now carry on and see what excitement the afternoon is going to bring. First of all, why be concerned about independence? Why are auditors worried about independence? Then we have a little bit of history, and then we get into the nitty-gritty, look at what PES3 says, what ISO 220 has to say, which is fortunately not a lot. PES1, which has a lot to say on the subject. Then a little reminder that people's perception is the reality. So what we think is independent is not necessarily what other people think is independent. Then we will look at examples of threats to the auditor's independence, examples of the safeguards that might be put in place. ISO 260 has something to say about it as well. Some things are absolutely prohibited. We'll check on those, and then some things are only put my other teeth in. They only restricted. Then we will look in some detail at non-assurance services, and this is the major area of concern to most auditors. Are they sufficiently independent in that area? And then we'll go on to what the FMA has to say about it. The FMA has firm views, and some other people have thrown their opinions into the ring. So here we go. Why should we worry? Well, it's about ethics. Ethics is not a county in England. Ethics is how we behave and how we relate to other people. It's an important part of our whole professional lives, and independence is very much an aspect of ethics. If we want to scare ourselves into being interested, it's one of the FMA's focus areas, and I suspect it will continue to be one, because they've been a little bit rude about some of the licensed auditors and their approach to independence. And of course, we want to do a good audit and be seen to be doing a good audit. And a fairish bit of independence is perception. Okay, long ago, auditing has been around for a long time. I'm reliably informed that the Greeks had a word for auditor, and Archimedes, well, it's maybe stretching it a little bit to say that he was an auditor, but his great discovery, and some people will be feeling rather smug because they know this story already, is that the king Hieron II of Syracuse had given a jeweler an amount of pure gold to make a votive crown. And he was concerned that the jeweler might have actually taken some of the gold and substituted another metal like silver or copper, which of course is much cheaper. And he was concerned, of course, that his offering to the gods would be less effective if it was not pure gold, and also he didn't like to be cheated. So he asked Archimedes, how could he tell that the crown was indeed pure gold? And Archimedes was the man who was in his bath and worked out the Archimedes principle, and then leapt out and ran through the town starkers saying, Eureka, I have found it. And what he had found was that if the crown was impure, any other metal was less dense than gold, and so it would be a less dense crown, and it would weigh the same, but it would behave differently in water. It would displace more water, or if you put it on a balance and put the whole balance in water, the balance would tilt. So Archimedes was, in a sense, an auditor. Then there was a time when, I call it DIY auditing. Company shareholders would elect the auditor, or indeed auditors, from amongst their own number. And even if they selected a professional auditor, the professional had to have shares to qualify, which is an interesting turnaround, because we'll see later on, of course, that if you own shares in your auditing company now, you're disqualified from auditing it. So these things go in cycles, but I don't think I'm going to live long enough to see shareholders doing audits again. And then at the time I was entering the profession, I was told that it was common for interviewing firms to ask, could I see your portfolio? But that had gone by the board, because by the time I was putting up my hand to say, can I come and work for you, Mr. Accountant? There were a lot of other plebs, and they did not have portfolios of share investments. But even in the 1970s, if you owned shares in a client company, you were at least debarred from working on that audit, and possibly going to be asked to actually sell that one. So, auditing in the past. Right, auditing now. PES3 is the quality control standard, as we all know, and it says in lots and lots of words, we've got to have policies on independence, and we have to establish reasonable policies, and we've got to maintain them. We've got to police them. And one of those policing actions is at least annually to get written confirmation of compliance with those independence policies from all firm personnel required to be independent. Now, this can be interpreted as all firm personnel who work on audits and other assurance engagements, but there is a risk that there are independence issues that go via other people. And there was an audit firm I've seen that was auditing a school, and unbeknownst to the audit section, which was in the main office, in another office, there was an employee whose husband was on the board of trustees of a client school. The employee was not an audit person, was not required to give an annual confirmation, and the firm was happily ignorant. And for FMC reporting entities, it's compulsory, and it's normal whenever an engagement quality control reviewer is appointed, that reviewer must include consideration of the independence evaluation as part of the EQCR. So it's important enough that if you do have an EQCR, then the EQCR will be expected to have a look at what did we do to ensure that we were and maintained independence. And ISO 220, again, it's quality control, lays it firmly on the shoulders of the engagement partner. The engagement partner must form an opinion on compliance with the independence requirements, which of course includes identification of all the threats and the installation of appropriate safeguards, and must document those conclusions. That's a fairly common issue that my career as a reviewer, I came across, well, all sorts of issues, including independence, where everything was all right, but it wasn't actually documented. So it's part of every audit's documentation. Okay, PES1, the Code of Ethics for Assurance Practitioners. It's a big document, and it has a lot to say about all manner of ethical things, but particularly independence. It spreads itself on independence. But it's a simple basis. 1, identify threats. 2, evaluate the significance of the threats. And then 3, apply safeguards when necessary to eliminate the threats or reduce them to an acceptable level, which means if we have to look at all the possible threats, see which ones apply, and Can we live with them? Can the world live with them? Can our client live with them? Can our regulators live with them? If not, what are we going to do about it to manage them, to get them down to a sensible, reasonable level? So the principles, pretty straightforward. Identify, evaluate, safeguard. Okay, a little question here, and I think I've got a poll for it, is how many fundamental principles are there in PES 1? Come on, computer. It's gone to sleep. Okay, we have to stop sharing and see my ugly mug, and we here we go, at last. Right, how many fundamental principles are identified in PES 1, Code of Ethics for Assurance Practitioners? And aren't I sneaky? I didn't give you the slide that will really sneak up the answer. Of course, those who have a copy of PES 1 beside them, and I bet there aren't many, can look it up. We all, of course, should know how many fundamental principles there are, because we keep meaning to memorize PES 1, but we never quite get round to it. Okay, we've got 8 votes so far. Come on, commit yourselves. I don't know who's voting what. So it's all right. You can't be, whether you get it right or wrong, I won't know who you are. Okay, we've got a range. Isn't interesting? This tells me that possibly our knowledge of PES 1 is not as detailed as we would like it to be. Okay, we've got 23 votes so far. Come on, at least 2 more. No abstentions. It's a number. 1, 2, 3, 4, 5, 6, 7, or possibly 13. We have 1 supporter for 13. Come on, vote. No, we've got some determined abstentions, so we'll end the poll there. And the popular result is that there are 5 fundamental principles, 11 out of 20, just over a majority. And I have to tell you that they are right. Well done, the majority. Those who got other numbers must have been guessing. So we'll close down the poll and go back to the slides. Which hopefully now you are seeing the question screen, and there is the answer. The fundamental principles of ethics are integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. And independence, of course, is a very big component of objectivity. So, what's involved in independence? It's independence of mind, lack of bias in our mind, in our approach, how we do our work, and importantly, independence in appearance. And I'd like you to have a look at paragraph. Now, here's some figures taken out of a listed company's annual report, which is a little bit old, but these are the figures as reported. And as you can see, the audit fees are $246,000 for 2015, which is a juicy engagement to have. Wouldn't you love those fees? And wow, look, we've got $117,000 for other assurance work and $237,000 for non-assurance work, making that a pretty significant client. $600,000. Yum. Now, I'm not going to tell you who this is because I actually have some behind the scenes information, and I can promise you that the audit firm took independence extremely seriously and documented exhaustively what the other assurance and non-assurance work were and whether they were complying with PES 1. And I believe they were, because I had a look at that. They were, in fact, independent. Well, the audit team certainly was, in fact, independent. But the reader of the financial statements has not seen all that work. What's the impact going to be on them? Is it going to be to say, hey, oh, well, the auditors must have done a lot of work to be worth 246 grand, or was it heavens above, or like expressions, we're paying that much to that firm? What kind of independence can that be? And those who remember Enron, the global audit fees for Enron Group, as I saw, it was reported, $52 million US, no, $50 million US, and non-audit fees were $52 million US. Now, how on earth can you be truly independent if you're beholden to your client for 50 million bucks? Or in fact, 100 million bucks. Yeah. Oh, I'm going to qualify the annual audit report. This is a partners meeting, and they're going to fire us, but I'm sorry, my mind is made up, and we're going to lose $100 million worth of fees around the global network. What are the other partners going to say? They're going to say, you must be mad. Maybe. I hope the Arthur Andersen partners would in fact have been more ethical. We don't know, because they didn't qualify. That is the impression that's all the readers of the accounts got, what the audit fees were and what the other fees were. Total 600 grand. So what's the reader's perception of materiality just from that information? It might be, yes. It sheds a different angle on it, different light. Okay, now, first, identify your threats. And threats come in a number of categories. They are the self-interest threat, how I make money. I might make money out of this. Self-review threat, auditing my own work. Advocacy, I'm promoting my client. Familiarity, I just know the client very, very well. And intimidation, the client's threatening me. So all of these can impact on our independence, or if not our actual independence, the appearance of independence. So that's quite a number of things that can be done. And so we will look at some examples of these. Oops. So self-interest, direct financial interest, meaning I can make money out of the client, particularly if the money would be related to the results that are reported. So if I've got shares in the company, that's a direct financial interest, and that's definitely a threat to my independence. A material indirect financial interest. Well, indirect financial interests are things like I've got money in a fund, a superannuation fund or what have you, and that fund has invested in my audit client. that gives me, I don't control that, that investment decision. They will buy and sell when, the manager will buy and sell based on the manager's own decisions, their assessment. But I've got a financial interest. So if it's material, it's accepted that if it's small, that's not a threat. But if it's significant, well, yes, there's a threat to that. Undue dependence on fees. There was the Enron one, and there is actually a figure for FMC reporting entity audits, which we'll see later. That's 15%. If we get lots of our fees from one client, can we be totally disinterested? A close business relationship. I don't think I've yet found an auditor who was actually in business with an audit client, but it doesn't have to be that kind of business relationship. And when, back in the 1970s, when I was a baby auditor doing my training in London, there was quite a hoo-ha in the business press when one of the big firms, I think it was Pricewaterhouse, but it's a long time ago now, was found to be auditing their own landlord. And this was felt to be improper. They weren't independent enough. The landlord could put pressure on them to say, no, I will not renew the lease if you qualify the audit report or whatever. So we have to be wary of close business relationships. Employment negotiations, if there's a member of the audit team who's angling for a job with the client, I've never come across this, but I know it happens, really. And contingent fee arrangements. Of course, we cannot accept an audit if the fee is going to be graded depending on what the final reported profit is, for example. And a self-interest threat where there's been a significant previous error by the firm, and the standard says in a non-assurance engagement. So if the firm has done something, maybe done some compilation in the past, and then to dump that and taken over the audit, for example, and the audit detects that the compilation work actually contained a major error, well, that's a threat. That's a self-interest threat, because if we tell the client, then the client's possibly going to want their money back for the original piece of work. So let's have a look at this one. And this is where we're going to use the chat. And this is not a million miles from something that's actually happened to me in my career in practice. A partner, a non-audit partner, of course, says, hey, I've got an audit for you. I've got a good mate, Tom, and he's fired his auditors and he's going to appoint us instead. And hey, that's good. We want that kind of referral. And so we get the professional clearances. The previous audit firm says there's no professional reason, and we draft up the engagement letter, and then you do a company search. And 75% of the shares are owned by Tom, Tom's wife, and your partner. Now, this is a bit odd. No, it's not at all. It's odd. It's quite normal. The partner is a trustee of Tom's family trust. But that's, I'm not a beneficiary. Is there an issue there? Thoughts, please, in the chat box. And to everyone, remember. Well, I'm hoping that they will be public thoughts. So we've had I don't accept. We've had a yes. Trustee liability would be an issue. That's I'd actually not thought of that aspect. We wouldn't accept. Now, of course, we might accept. If we wouldn't accept, why not? Now, which kind of a threat is this? And it's all right if you want to say, yeah, I could accept that. Well, it's all right at the moment. So, yes, it's a threat to independence. It is indeed. Which category of threat? Is it self-interest, self-review, intimidation, whatever the others are? Perception overrides independence. Yes. We're getting messages to all panelists, and I'm all the panelists, so you're right. It's okay. You can say to everyone. The perception would certainly be that you wouldn't be independent, and ensure the associated partner is removed from the audit. Okay, we'll accept that the associated partner is right outside the audit, business services partner. Is there still a threat there? And I think there is. Yeah, self-interest, direct financial interest. Well, some people would say they're not a beneficiary, so there's no direct financial interest, but there's I think there is. I agree with that comment that it's it's direct, but even if you don't agree with that, then you have to say there's an indirect interest in that their performance as trustee is reflected in the results. And my personal view, we don't seem to be having too many more comments, is that it's an absolute no-no, because suppose there was an audit failure, then the shareholders, and one of the shareholders is your partner, would have to sue the auditors. So he'd be suing himself. It just can't be done. It's an absolute no-no in that case. Okay, in the chat, carry on. Self-review threats. The common one is auditing material prepared by the firm. And whilst this is not an absolutely forbidden, it can be difficult to put in good safeguards. A member of the team is or was recently a director or officer of the client, or an employee in a position to materially influence the audit subject matter. Oh yeah, that's that one. The firm is performing service that affects the subject matter of the insurance engagement. For example, valuations. If the client has some shares and they are being fair valued, and they say, "I will get your firm to tell us what these shares are worth," then that's a clear self-review threat. We're not reviewing the valuation methodology, are we? Oh yes, of course we are, because we're auditors. If it's significant, the value of those shares is significant to the audit, then we're reviewing our own firm's work. Advocacy threats. Promoting investments in a client. I've never seen this. Has anyone seen it? Oh, we've got a question. So I'll look at the question after this slide. If you're promoting investment in an audit client, that's absolutely forbidden. You may not promote their shares or debentures, or act in as an advocate in litigation or dispute. And this, I have seen this, and we might get to an example of that, which is acting in dispute with Inland Revenue. So I have to stop sharing to have a look at this question. Okay, so the client doesn't have an accountant and they keep some basic records and I'm formatting it. Is this a serious issue? That's a very, very long question. And I'm probably going to cheat on this one and save it up and see if we've got any time at the end. Otherwise, I'll cover that off with you by telephone outside the webinar, if you'll excuse me, Dave. But hopefully we will cover to some extent to what you can do for assisting the accounts. Right, familiarity threats. Close family member is a director or officer or influences the financial statements. How close does it have to be? Oh, hang on. You can't see the screen. You can't see the slides at the moment. Hopefully you can now see the slide again. And I was once asked about this, and the question it was, my brother-in-law is on the committee if it was a not-for-profit society, not-for-profit body, although not a trivially small one. Is that an issue? And well, the brother-in-law does not live with you. No, he lives with my sister. They're married and they're in a different town. And I ended up deciding that it was really a case of, well, how close is that? Is it someone, now if it doesn't actually have to be a relative by marriage, but if it's someone you say play golf with every weekend, I'd say that's close. If it's someone you see once a year, that's probably not. I have 3 brothers-in-law. One lives in Christchurch, and I see him probably 3, 4, 5 times a year. We get on very well. I would call him a close family member. One lives in Hamilton, and I see him maybe once every 3 years. I wouldn't call him a close family member. And the other one lives in Birmingham, and I've seen him twice in all history, so I don't think he's a close family member either. But this is the kind of issue that we have to make a judgment call on. How close is close? A member of the team is able to influence the subject matter, so a member of the audit team is somehow involved in the preparation. If a director was recently the engagement partner of the audit, a familiarity threat. I've never actually come across that situation. An audit partner going to be a director of a client, but I dare say it's happened somewhere. And then accepting non-trivial gifts, because they might be perceived as bribes. And I'm delighted to say that, yes, I was once offered a non-trivial gift. I don't think it was offered as a bribe, but it was when I was a manager and the partner and I were in the client's premises in the audit room, and it was during our lunch break, and we were talking about our plans to go skiing. And the chairman's secretary came in with probably some document we'd asked for, and heard this, and she said, "Oh, go and stay at John's ski lodge. He won't mind," and cheerfully offered us accommodation at the chairman's private property near Mount Ruapehu. Well, I have to say that we did decline very politely, and I don't think the PA realised that she was offering us a bribe. And I also think that that particular chairman would have overruled her and said, "Over my dead body, are they going to use any of my goodies?" But there you go. So if you are offered a non-trivial gift, I'm afraid as auditor you must turn it down. And then this is the tricky one: long association of senior personnel, and people say, oh, that's FMC reporting entities only. They've got to rotate off after X years. Well, yes, that's true. But just because it's not an FMC reporting entity doesn't, and there's no no regulation that says the audit partner must rotate off, does it mean there's no threat? And the answer is there certainly is a threat. And I, as a reviewer, I once looked at a file and I asked, oh, how long has the partner been associated with this? And we worked out that the partner, the manager, and the field auditor had all three been doing that job for at least 10 years. They actually couldn't remember how long. And was that a familiarity threat? Yes, it has to be. The threat is still there, and if the safeguard may not be compulsory rotation, but a safeguard of some kind is required. Here's one. You are an auditor sole. It's just you, and you've been auditing Kiddie Squeal preschool for 18 years. And we've got a poll. Now, it's definitely not an FMC reporting entity. Do you think there's a threat to your independence here? And you do not prepare the accounts. The accounts are totally prepared by another accountant, and they are sensible final accounts. So you're completely independent of accounts preparation. You've been doing the audit on your own for 18 years. Is there a threat to that? Is there a threat there? And so far the votes are all that yes, there is a threat. There absolutely is. Okay, we'll end that. Well done. Yeah, 23 out of 23 who voted. It was, yes, there is a threat there. It's that threat I've just been talking about. So what are we going to do about it? Well, we will look at the various possibilities for safeguards, but in this case, I think what you have to do is get an independent auditor to review the audit approach every so often, maybe every 3 years, something like that, because doing the same job year after year after year, you do get into a rut. And I saw it in myself. I was the engagement partner. It was my favorite client. They were great people to work with. But I was starting to do that audit in my head before we even got there. And that's the wrong space to be in. So there has to be that professional skepticism. And we have another question, which I'll look at next time we leave the... and we'll... since I just talked about that, and because of the time, we will skip using the chat on that discussion. But we will here. Now, and I have to say that whilst this is based loosely on an actual event, I was nothing to do with the actual event. So you discover that you have two field auditors, you're not a large firm, and one of your field auditors became friendly with the client's office manager, indeed very friendly, and they're now living together. So, chat and say, what would you do about this if that was happening in your firm? Yeah. Familiarity breeds contempt. And the and someone must have seen this one before. Remove them from the team, review their interim work. Have the work reviewed again in the light of the lack of independence. Absolutely has to be removed from the audit team instantly. And okay, that means you've just lost 50% of your field auditors, but there's no way you can do anything about that. You maybe should re-review their work, their interim work, because now we don't know how the office manager affects the accounts, but I don't know any office manager who's completely divorced from affecting the account. Yeah, so we probably will re-review that. And this is, of course, just before balance date, and it's a terrible time, but it's got to be done. And intimidation threats, I hope you don't come across too many of these, except this one. If you qualify the audit report, we'll fire you and get another auditor. Yes, I've had that one. Not often. And then, well, if you qualify the audit report, then we're not going to give you such and such a contract. I've never been in a firm that was looking for other contracts, so I've not had this one happen to me personally. It's the same sort of thing. If you put that in your audit report, we'll sue. Yes, I actually have had that said to me. It was an empty threat. There was nothing to sue over, but someone was pretty cross. And I don't think an auditor has ever, I can't think of an auditor who's actually ever been sued or threatened with litigation before they issued the report, but I dare say it's happened somewhere. You've never come across this one, of course. Pressure from the client to reduce the work and reduce the fee. You don't need to do all that stuff. We do need to do it. That's why we're doing it. And then pressure from a client expert. Our expert says this is not totally uncommon. It doesn't happen often. I learned to be polite and simply say, well, let's see what your expert says, and then retort with what we say. And if you get something that gets sort of at loggerheads, well, you can recruit your own expert. You have to report your own opinion, not the client's expert's opinion. And this is one, fortunately, I've never come across an example of this where, say, another partner, not the audit partner, tells an employee that they'll never be promoted if they put that stuff on the audit file. I have put things on the audit file that the partner disagreed with, but I think in every case it remained on the audit file. And I have to say, in most cases, the partner at the time, when I was quite young, was quite right. But there you go. Now, what are we going to do about it? First of all, effective quality controls. And if we can avoid the independence problems at the outset, that's always a good thing. Then the famous Chinese wall. So we have audit assurance work in one part of the firm and other work in a completely separate part of the firm. There's no overlap of personnel at all, even at the partner level. And that excuses quite a lot, but it's not the perfect answer. I have an example. When I was a partner, the firm was large enough to have a Chinese wall. And the day came when the auditor found an error in the compilation work. And the field auditor went upstairs to the preparer and said, I don't think this is right. So they talked it through and they decided that indeed it wasn't right and an adjustment was required. And it was quite a large number. It was a very complicated situation. And the first thing I did was not go to the client and say, your accounts are wrong, get them fixed. I went to see the business services partner and I said, the accounts have to be changed. How are we going to present this to the client, because we wanted to do as little damage as possible, of course, to the firm's name. So yes, the accounts did get changed, and in fact, the client's response was, "Oh, okay. Well, well done for finding that." But we were a little nervous about the reaction, because the draft accounts had already been to all the directors. It was bad timing. So the Chinese wall is a safeguard, but it's not perfect. Advising everyone about the clients where independence is required. So once a year, hopefully, we all send around to the firm, the whole firm, a list of clients where independence is necessary. And those, and everyone will confirm that, yes, I am independent. But particularly in larger firms, clients come and clients go, and people are employed and people go. And keeping up to date with who has to be independent of what can be quite an issue. Independent review. In many cases where there is imperfect independence, then we can have an independent review to say, okay, how are we going here on, is this a reasonable audit approach? And it can be quite good to get someone, a fresh pair of eyes in, who might say, well, yeah, that works, but have you thought about such and such? And Pisa Limited does this for a couple of people. We do occasional independence reviews where they've been doing the same audit for quite a while. And disclosure to those charged with governance. Well, does disclosure solve the independence thing? Well, it doesn't solve it so much as determine how important it is. One example is, I had an inquiry that the client, the firm had an audit where there was some work that needed to be done remotely. They didn't have an office there, but they did have a contact who, I think it was attending a stock take, anyway, whatever it was. And they found the individual who they were using was actually a shareholder in a competing company. So, well, what can we do? We don't know anyone else in this town, and it would be damn expensive to fly someone up there. So I said, well, go to the client and say, do they mind? Is this person going to learn, trade secrets from the work they're doing for you? Well, probably not. Okay, ask the client, is this an issue? Are you happy with this? And if they say that we don't like it, then you've got to find someone else. But if they say that they're happy with that, carry on. And that's what happened. They asked the client said, fine by us, and they carried on with the existing arrangement. And in some cases, you actually have to disclose to those charged with governance, that's mainly FMC reporting entities, and get their acknowledgement that they're happy with them. And of course, you can remove the threat carrier from the team, because a lot of these independence issues are based around those working on the job, not the whole firm. So if it's a field auditor who's cohabiting with the client's accountant, remove them from the team. If it's the audit partner who's been 7 years as engagement partner for an FMC reporting entity, they've got to leave the team for at least 2 years, which might go up. And having an audit committee, which is not something that the audit can do. The auditor can suggest it. You don't have to be a big company to have an audit committee. I had quite a modest-sized company client that got in an external director and insisted there was an audit committee. And the audit committee met once a year, just before the audit was finished. And it was the external director and the chairman and the auditor. It was a small committee, and it was basically, because it was a tidily run company, is there anything we need to know? No, there's all, everything in last year's management letter was attended to. Here's the draft of this year's management letter, and you can see it's pretty trivial. So we were all over in 15 minutes, but the process was excellent. So FMC reporting entities considered to have a higher level of public accountability. That's old issuers, roughly, the equivalent of. The auditor must communicate independence matters. Statement that the engagement team, the firm, and network firms have complied with independence requirements, and all relationships and other matters that bear on independence. So it's not enough to say, dear directors, we're independent. You have to say, and we've considered the fact that, boom, 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 if there are any other relationships that we do, say, tax agent work or whatever. Now, some things are absolutely prohibited. We cannot get around them. A direct financial interest, unless it is, if you've got maybe one share in 100 million with a dividend of 5 cents every year, I think you probably could get away with that. But as a rule of thumb, if you've got any shares, any direct financial interest, you can't do the audit. If you've got a material indirect financial interest, you can't do the audit. If you act as a director or officer, absolutely, I truly did not, I'm not making this up. I was presenting a seminar many years ago in a provincial town, and we were talking about audit independence, and having talked about it, someone in the front row put their hand up and asked a question. He said, so does that mean I can't be chairman and auditor? And full marks, he had understood. How on earth he ever thought he could be chairman and auditor, I didn't dare ask. I felt I might have wept. We must not have, as auditors, management responsibility. We'll talk a little bit more about that later, what that is. We mustn't authorize transactions. And would an auditor ever do that? I've seen it. It was in writing. I authorized investment in from the audit partner. An audit partner who did not know the code of ethics, and actually between you and me, he didn't know too much else about auditing. And it's absolutely forbidden to act in an advocacy role. So we cannot promote the shares and do the audit. And we all knew this. We cannot be an auditor and then act as receiver or liquidator. And we can't receive contingent fees. I've never been offered contingent fees in an audit, I don't think. I've been offered shares as payment, and we had to explain about Prohibition 1, that if you pay us with shares, then we have to resign the audit. It was a startup company, and the shares were their currency. Prohibited loans to or from, guarantees to or from a client, unless it is a bank or otherwise in the business of lending or borrowing. So if it's a regular lender or borrower, it might be allowed. And then it will very definitely be not too large, not too major, and very much on the same terms as the general public. Custody of client monies or other assets. I don't think I've ever been asked to look after anything except a few accounting records over the weekend, so that's not a common one. But there's no, in these cases, there is no safeguard. You cannot get around it. And I'm going to have to come out of the slides there, because okay, what are the practical ways of mitigating the long association threat? I've mentioned getting a periodic independent review. So another experienced auditor to have a look at what you're doing. And it is very much a case of what kind of client is it. Now, obviously, it's not allowed for an FMC reporting entity. It's generally okay for small and simple audits, but the bigger and more complex the audit is, then it will depend to some extent on who you get to sort of do your peer review. Yeah, it's in like so many things in auditing. Professional judgment has to be applied, and there's no nice, neat black and white line on that one. And yes, it does cost. Well, unless you've got a very, very friendly nearby practitioner. But long association threat, how do you deal with it? That's the only way I know. Okay, to the slides. Yeah, it's absolutely forbidden to act as a director or officer. No safeguard against non-trivial gifts. As I say, that counts as a bribe. Okay. Now, here's one for you. We are in a firm that's big enough to at least have 2 partners, and you're the audit partner. And the audit fee is in the region of $5,000. And the firm assists with the preparation of financial statements. So we will assume that it is, they take the client's final trial balance and format financial statements for the director's approval, of course, and they do the tax returns. And the non-assurance work, the non-audit work, is normally a fee of normally about $2,000. Okay, audit $5,000, other work $2,000. That's not too bad. And then you get the firm's WIP report every month, and you see on this that there's the unbilled tax work of $12,500. This is unexpected. So you go and audit it, and you say, what's going on here? And the answer is that the client is the subject of an IRD audit. And your partner is assisting, because the IRD has done their audit, and they say that over the last 7 years, the company has claimed nearly $2 million of capital expenditure as maintenance. And of course, and therefore they have to pay a lot more tax. And your client is arguing vehemently that indeed it was maintenance. So, what would you do in this situation? Seems some of the audit work on R&M wasn't so flash. If it's a surprise, yes. Now, we don't have to presuppose that the IRD never makes a mistake, but if there was something that was debatable, we should have been aware of that in the past. What do we do about it? We're in this situation now. What threat to independence is there here? Or are there, in fact, there are more than one? What are the threats? Do we have a direct financial interest? No. Dodgy Dick's Contracting Limited is owned by Dodgy Dick and his family trust. Ask myself some very serious questions about my competency. Well, yes, that's a kind of it's something that in a contracting company you would normally have a look at maintenance. You would expect there to be a reasonable amount of maintenance, but that's, one would have hoped that that would have been identified as an audit risk, that it might be misclassified. What else? Threat, self-interest. Could use an external reviewer. No, I don't think there is a self-interest threat here, except unless you think that $12,500 of tax work is, is major to the firm. We're not looking looking at a major part of our income here. So I'm sorry, I'm going to disagree with that. Could use an external reviewer. Well, we're not having many comments about. I think that this is, and there's some self-review here, that we're auditing our own work, but mainly it's advocacy. We are now advocating for our client in a dispute in the revenue. And advocacy threat cannot be safeguarded against. It's a prohibition one. And so the only thing I think that we can do is resign the audit immediately. Of course, if we've not been doing the audit for all the 7 years and the amounts are quite small in the time we have been doing it, then would be a case of, well, how long have we been doing the tax work as well? But in that case, consider withdrawal. I don't think really we've got any option. Well, we can either withdraw, or we can stop doing the tax work, because the tax work has clearly gone over the line from simply compliance and mechanically filing tax returns to advocating for a client in a dispute. Close my window and go ahead. I listed all the restricted things, which is everything else. And we're not going to talk about those because they're there for your record in the notes. But anything else is, if it's not absolutely forbidden, then we have to look at how significant is the risk and what can we do about it. If it's really, really trivial, we don't have to do anything about it. So there it is, loan to or from a bank. If the client is a bank, yes, we can use that bank, but only in a fairly ordinary, everyday way, and definitely without special deals. Interesting, if a current team member anticipates working for the client, they don't have to leave the team, but you do have to have a safeguard. Okay, here's the big one: non-assurance services. Undertake a deep review of staff or own work papers. Yeah. So, providing accounting or bookkeeping services creates a self-review threat. But the standard does acknowledge that dialogue, discussion around internal controls, which accounting policies apply, checking disclosures and proposing journal entries are a normal part of the audit. Now, we can propose journal entries, but if we authorize the journal entry, that's management. We mustn't do that. And in major sophisticated clients, that's not a problem. We propose journal entries, and they've got competent accounting personnel to say what's that and why, and audit the auditor. But we've probably all got a client that says, oh, look, if you want any changes, just tell me and I'll do it. So in principle, we're behaving like a manager by proposing a journal entry since we know it's going to be processed. In practice, of course, we have to do that, but we do please make sure that the client understands them and formally approves them. Yeah, I mean, it's, you know, the overriding thing here is that the client must take the responsibility for changes to internal controls, accounting policies adopted, the disclosures that are made, and the journal entries that are processed. And interestingly, these things don't create a threat. Resolving reconciliations. Have you ever had a client who said, I can't get this reconciliation to come out? And who's the hero who's going to come along and fix it? Of course, it's the auditor. Regulatory reporting. Interestingly, that the auditor can do regulatory reporting, such as mechanically filling in a tax return and filing it. And that's not creating a threat. And technical advice on accounting issues. Now, this is something that can be taken advantage of, and I personally think it has been taken advantage of in some occasions. Where do you draw the line between technical advice and actually compiling the accounts? That's a very tricky one. What's the FMA's review? I'm asked on the technical advice on accounting issues. And the FMA has a very strong view that the auditor should not be the client's technical department. So the standard says technical advice on accounting issues does not generally create a threat. And yes, the major firms do offer technical advice. But going beyond that technical advice is tricky. Now we're running low on time, so I was going to ask some questions of. Oh, look, let's do it with a show of hands, maybe. Okay, your client says, I don't understand about this these related party proposal. This standard is puzzled me. Could you draft me a related party note? Now, as auditor, do you think that that's okay? Raise your hand if you think it's okay to draft the related party note. We're talking here about a tier 1 or tier 2 reporter who has significant significant disclosures to make. Okay, so far we've got 2, a few. Yeah, we've got a few, not a very large number. And we have a yes. There's no. I don't believe that there's an actual right or wrong answer on this one. It's just. Okay. I can lower all hands. Now, so some people at least would be happy to draft the related party notes. What about the statement of cash flows? The client's accountant is okay with the balance sheet and income statement, but gets bogged down in the statement of cash flows. Dear auditor, could you prepare the statement of cash flows for me? Raise your hand if you think that's okay. So remember, the statement of cash flows is a main statement. And okay, we've got 4, 5 out of 30 so far. I think that's okay. Well, someone's decided to change their mind. They're taking it down. 4 out of 30. That's similar. I asked when I asked the question at a seminar some years ago. Drafting a note was by and large okay, but drafting a main statement was by and large not okay. As I say, there's nothing black and white in the standards. It's a professional judgment matter. And personally, I wouldn't draft a main statement. I would probably draft a note. Mind you, the related party note's getting more and more. And it would depend on who the client was and all other circumstances. The smaller and simpler the client, the more willingly I would do that. And again, resolving reconciliations, giving technical advice, so long as the client takes responsibility for the action afterwards. And quite a few firms insist on the client signing off on the journal entries. They say, here are the journal entries we are proposing, and they get a manager to sign to say approved, so they can prove, so that they can prove to their regulator that we proposed this and the client took the responsibility for actioning it. So this management responsibility thing, that management set policies. Haven't seen too many auditors setting policies, although of course we recommend them in management letters. I've only seen one auditor authorising transactions. I hope I never see another one. Managing bank accounts or other assets. That's definitely a management thing. I don't think I've seen an auditor doing that, but I have seen auditors partners, elsewhere in the same, I've seen audit firms doing that, and I'm not happy with that. And reporting to those charged with governance on behalf of management. So if management have to do a report to the board or to the committee, then that's a management function, and the auditor must not do that. And big no-no, taking responsibility for the preparation and fair presentation of financial statement. And to what extent, where does the responsibility begin and end? And it was quite a few years ago, there was a case where there was an issuer, and as was not entirely uncommon, the issuer had no an accountant, but was not competent to do a set of IFRS accounts. So they got the auditor's firm to prepare them. There was no formal, well, no one showed me any formal authorization and acceptance by the client, the business services team, which was indeed completely separate, different partner, everything. In fact, they were possibly even in a different building. They did all the work, but the client, to be honest, even if they'd said they were taking responsibility, didn't have the knowledge to understand what they were taking responsibility for. And the the regulatory body I was representing at the time took a pretty dim view. And taking responsibility for internal controls. Again, auditor can suggest, management has to say, okay, we'll do that, and take the responsibility. And no, I've done that verbally. So, what has the FMA found? Well, in its 2016 Audit Quality Monitoring Report, it found engagement letters that included prohibited services. Now, isn't that careless? I've seen this. I wasn't doing any work for the FMA in 2016, so I can only tell you what I've seen. And it wasn't the audit engagement letter. The audit engagement letter was a model. It was the tax partner who used a standard engagement letter that said, oh, we'll do this and this and this and this, including things like, we will fight tooth and nail for you against Inland Revenue, which of course is a prohibited advocacy activity. And the auditor that firm actually did have a procedure that non-assurance work had to be signed off by the audit partner, and it was, but he didn't see the engagement letter. The work that was actually done was indeed okay, but the engagement letter was a standard and included prohibited services. Not a good look when the FMA come around. They found no evaluation of threats. I never saw an issuer audit file or an FMA file that didn't evaluate threats, but clearly someone has. Then we had threats, but no appropriate safeguards. I mean, those two are just careless. And we identified safeguards, and then we didn't do them, and that is stupidity. I hope that no one here this afternoon will be guilty of that. Audit and non-audit work performed by the same team. Yes, alas, I have seen that. Not very often in recent years, but it does happen. And Dave's question I'm going to deal with it will definitely be later. Shows that it does happen. And because of the size of some practices, it's very difficult to avoid this, but it is a major threat. And so when we're talking about FMC reporting entities, I cannot imagine the circumstances when that would be sensible. Certainly. What else did they find? The appearance of independence not considered carefully enough, and they specifically referred to non-audit services that were several times the fee of the audit. So the figures I showed you apparently aren't the most extreme. And the audit file did consider independence. I can picture it. PES1 says that para thing, blah, 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 and we're okay on this. But it didn't say, and this is going to show that non-audit fees are 5 times the total of audit fees, and the whole world is going to think that we're just milking this. And this is another pretty silly one. There were no audit services, and they weren't properly disclosed in the financial statement. Now, heck, it's not a difficult note. Fees paid to the auditor for auditor financial statements, for other assurance services, and non-assurance services, boom, 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 as the example earlier. And they weren't properly disclosed. Okay, the client didn't know the proper disclosures, but the auditor didn't pick it up. Auditor really does deserve the smack on the hand they got. And then threats from non-audit services and related safeguards weren't reported to those charged with governance. Well, as we saw earlier, that's a compulsory matter. You've got to report them for FMC reporting entities with higher public interest. Okay, and this is what the FMA said. They expect audit firms to place more emphasis on the conceptual principles of independence and not just consider each non-assurance service in isolation. So they're saying, you've got to look at the wood, not just the trees. You've got to do more than say, oh, we're doing this, and because a paragraph thing and by paragraph the other, that's allowed, and do that every time. You've got to say, and overall, what's the effect? What's the impact? And I have to say that I agree with them on that one. We do have to say that okay, this little bit here is okay. This little bit here is okay, and then look at the big picture as well. And it has to be reviewed by the engagement partner and the engagement quality control review partner. Definitely, EQCR on FMC audits should be very concerned with independence. And what do other people say? this is rather odd. I found some comments by the Australian Tax Office, and they all related to self-managed superannuation funds. And Australia's absolutely awash with self-managed superannuation funds, and they all have to be audited apparently. And why was the tax office interested? I'm not quite sure why they were interested, but this is what a non-auditor said specifically about independence. They found there are a lot of auditors also acting as tax agents. And the comment acknowledged that that didn't necessarily mean that independence was improper, but they said there was a lot of times a tax agent is also the preparer, the compiler. And so they were looking at that because they're saying auditor as tax agent, probably okay. Auditor as preparer, not okay. Reciprocal audits. And I have to say that I and other practice reviewers have been recommending this arrangement. And the reciprocal audit is that firm A says, look, we can't audit the super funds that we prepare the accounts for. So the ones that we compile, firm B, you do all those audits, and we'll audit all the firm A will then audit all the ones prepared by firm B. No, nice. And they might be next door to each other. It might be a very convenient arrangement, but the ATO are looking at that squiggle-eyed and saying, is this really independent? And worse than that is what they call swapping within the firm, which is partner A and partner B within one firm. They got quite caustic about that. And then multiple referrals. So if we're getting a lot of audit work referred by one firm or one source, then are we truly independent? An interesting concept. And this is, I say, this is someone who's not actually in the audit industry. And then personal relationships. And the example that was given in the document was the son auditing all the super funds compiled by their father. So, yeah, I would say, yes, I would look pretty squiggle-eyed at that as well. And I did once review an audit file where the accounts had been prepared by the practitioner's daughter. And I didn't think the compilation was wonderful, and I thought the audit was worse. It was certainly not independent. So if anyone is really interested, I can send you a copy of the text. I haven't got a copy of the document, but I copied and pasted what the ATO said. And here's another interesting comment by CPA Australia, someone in the administration of that institute. And he said that the second most common issue in terms of auditing standard breaches, that's detected by their review program, their practice reviews, is independence breaches related to super funds. Second most common issue is independence breaches, and he's not saying that it's not understood or not documented. It's actually breaches. So that's Australia. That's in Australia, but there's no reason to think that it would be terribly different here. Certainly, in my life as a reviewer, I found very many breaches of independence requirements, usually through ignorance. And once or twice, it was a bit more than that, I think. Like a compilation accountant preparing the accounts, and then the client needed an audit report for because it was a private trading establishment, and the compilation accountant simply signed the report. No, I know my client. I know these are right. That's fine. Sign. What work have they done? What assurance work have they done? None at all. And that brings us to the end of the prepared session. Now, it's been a long one. It's been a full hour and a half. I haven't had any major questions. I've still got a couple saved up. But remember, the next webinar is only 2 weeks away, February the 8th. We get a bit of a rush now, so we get them all done well before March balance date and stupid season. So if you do have questions to bring up in the next webinar, they'll be very welcome. Just email them through to me. I have one question that I have to deal with outside the webinar. Otherwise, stop that. Otherwise, thank you everybody for your attendance. It's been great to know that you're there, and I hope you've got something out of this, more than simply 1.5 hours of continued professional development, something that you can actually use in your audits. Of course, you can email me with all sorts of questions in the meantime. Otherwise, I forgot what the topic is for 2 weeks, but I'll remember before we get there. And if I, okay, last few comments. Okay, thank you very much, chats. Right, that's it. I'm saying goodbye. I've said goodbye, and I'm now going to stop recording. The recording will be uploaded probably tomorrow. Anyways, very soon you will get the link. So if you're absolutely desperate to see it all over again, you will be able to do so. Goodbye then.